Today, we're going to go through Chapter 10, which talks about retirement savings. Now, the big topic in Chapter 10 is about RRSPs. So the big topic in Chapter 10 is about RRSPs, Registered Retirement Savings Plan. And we talked about the fact that if you put money into an RRSP, the amount that you deduct or the amount that you get as a deduction is a 3C deduction. So remember calculating net income for tax purposes, those 3C deductions. Last week, we talked about moving expenses, childcare expenses, spousal support paid. And then another 3C deduction is RRSPs. Now, when it comes to RRSPs, the maximum deduction is based on this formula here. So this is the formula, which will give us your maximum 3C deduction. But the thing about RRSPs is that you still must put money into the RRSP to get the deduction. So what do we mean by that? Let's say you calculate this formula, A plus B plus R minus C, and you get $10,000. $10,000 is the maximum you can deduct in 3C, but you actually have to put $10,000 into an RRSP in order to make that deduction. And the RRSP that you set up will be with a bank, a financial institution, and you put money in, and basically it's sort of a tax sheltered investment. We talked about last week how RRSPs are tax deferral. You put the money in this year, you get the deduction, and then when you take the money out when you retire, that's when you get taxed on it. So there's many, many years of tax deferral. And during all those years that the money is in the RRSP, it will grow tax-free as well. So you put the money in an RRSP, you invest it into exchange traded funds, into some stocks, into some mutual funds. All those gains and interest, dividends, all that will accumulate within the RRSP, and you will not be taxed on those amounts until you take them out, the money out of your RRSP. This formula here, there's sort of four parts. There's the A, B, R, and C. Now the R and C, we rarely see those in real life, and they're not usually included in any of the textbook problems. I'll explain what the R and C are later, but we'll just sort of focus on the A and the B. So the A is any of the deduction that you did not use up last year. So if we calculated last year's RRSP deduction to be 10,000, and then you didn't have any money to put into an RRSP, so you couldn't use any of that 10,000 as a deduction, that amount will carry over to next year. And so that 10,000 will be next year's opening. That would be the A amount. And then we get into the B amount. B starts off with the lesser of this set amount, which is set by the government every year. And for 2024, that amount is $31,560. And the lesser of that amount and 18% of last year's earned income. So if you remember last week, we also came across the term earned income as it relates to childcare expenses. The earned income definition for RRSP is different. And I have that definition down here. We'll look at that later. But as you can see from this B definition, is the lesser of this RRSP dollar amount and 18% of last year's earned income. So what that means, if you did not have any earned income last year, then this amount would be zero. So you would not be able to make any, the B would be basically zero. And so the B amount depends on last year's earned income, not this year, last year's earned income. So that's sort of important when we do this calculation. And then whatever the lesser of those two amounts are, it has to be reduced by the pension adjustment for last year as well. And the pension adjustment is basically any amounts you put into an employer-sponsored pension plan. So remember in Chapter 3, we talked about the fact that sometimes you contribute to an employer-sponsored pension plan. Those amounts that you put into the employer-sponsored pension plan, along with the amounts that your employer matches or puts in as well for your benefit, those amounts added together are the pension adjustment, and that will reduce the amount you can contribute to your own personal RRSP. So it's just trying to say that if you put money into a company pension plan, that will reduce the amount that you can contribute to your own RRSP that you set up on your own that you do, for example, through your bank. And so it just sort of sets an even playing field that those people that are self-employed, obviously they don't have a company-sponsored pension plan. And so just to put everyone on an even playing field, if you are working as an employee and you do belong to a company pension plan, the amounts that you put in along with the amounts that your employer put in, that is your pension adjustment, and that will reduce the amount that you can contribute to your own RRSP. So what I want to do then is walk through a simple example before we get into sort of the details of what is included in earned income and so forth. So the reason I want to sort of work through this simple example is because there's so many different terms that come up. And so I kind of want to explain all the different terms that come up as it relates to RRSPs. So we have this formula, A plus B plus R minus C. And once again, we're not going to worry so much about the R and C. I'll explain what those are later. The A is the amount that was unused from last year that carries over to this year. And then B is based on last year's earned income. So let's say it is the year 2022, and this is the first year that you were working. So you had no income in the prior year. So you had no earned income last year. Thus, the B will equal to 0 because it's 18% of last year's earned income. And if you had your 0 earned income last year, the B amount would be 0. So there's the RRSP deduction will equal 0 as well. And once again, if you had no earned income and no income in prior years, there would be no A amount that carries over as well. So if this is your first year that you're ever working, 2022, no income in any of the previous years, you would have had no income, no earned income last year. So your RRSP deduction is zero. But let's say in 2022, your gross employment income was 100,000. This is the first year that you're working. And then you also put money into a company-sponsored RPP. And in the RPP, you contributed, let's say 1,500, and your employer also put in 1,500 as well. So with a lot of company-sponsored pension plans, your employer will either match or put in a certain percent of what you contribute as well. So for 2022 then, if you remember from chapter 3, your net employment income, the amount that you include in 3A, will equal the 100,000 minus the amount that you put into the RPP. Because remember, if you put money into an RPP, that's going to reduce your net employment income. That's the same thing as RRSPs, is that tax deferral. You put money into an RPP through your company, you get a deduction when you're calculating your net employment income. And so you don't have to include that 1,500 in your net employment income because you put it into a company-sponsored pension plan. And then once again, when you take the money out of the company pension plan, when you retire, that's when you get taxed on it. So it's the same concept of tax deferral. So in 3A, you would only have to be taxed on 98,500, and the amount that your employer contributes is not a taxable benefit. So those are the concepts that we talked about in chapter 3. So let's move on to next year then. So next year, 2023, we are now going to work through the A plus B plus R minus C. Once again, we'll just sort of ignore R and C. We'll just assume that R and C are both equal to 0. A will be equal to 0 because there's no amount that carried over from last year. Remember last year, we didn't have any RRSP deduction because we didn't have any earned income in the prior year. So there's nothing that carries over to 2023. And then we get to the B amount. B is the lesser of the RRSP limit. Now, this limit changes every year. This is the limit for 2024, this 31,560. That's the limit for 2024. It increases every year. So for 2023 then, the RRSP limit, and once again, it's talked about in your textbook, but once again, don't worry so much about this because we're looking at sort of the previous year. In 2023, the RRSP limit was 30,780. This was the 2023 limit, and 18% of last year's earned income. So then the question is, what is earned income? And this is sort of where we get into the definition here of what is earned income for RRSP purposes. Now I'm just going to focus on the first bullet point. The first bullet point says we include or we add employment income, but compute it without the deduction for employee RPP contributions. So what that means is that for this definition of earned income, we take the employment income, but we don't take the deduction of the RPP, because remember this 98,500, we deducted the RPP here for our 3A purposes, but for purposes of earned income, we add back that 1,500, so we get 100,000. So that's our earned income. That's our employment income without deducting the RPP contribution that we made. So earned income is going to be basically 18% of 100,000. And so 18% of last year's earned income, which is 100,000, that's going to be $18,000. So the lesser of the 30,780 and 18,000, well, this is obviously the lesser. But then that amount needs to be reduced by last year's pension adjustment. And this pension adjustment is basically all amounts contributed to employer-sponsored pension plans, both employee and employer contributions. So then what is last year's pension adjustment? And once again, if we go up here, last year we put in 1,500 into the company's sponsored pension plan, and our employer put in 1,500. So if we add those together, the pension adjustment is going to be $3,000. So the 18,000 needs to be reduced by last year's pension adjustment, which is 3,000. So then our B amount is equal to 15,000, 18,000 minus 3,000. Since R, C, and A are all zero, the maximum, the formula then that gives us our maximum RRSP deduction for 2023 will equal $15,000. And I put the answer up here as well. And that's sort of how we got the 15,000. Any questions about how we got the 15,000, first of all? So that's the maximum that can be deducted. But once again, you must put that money into an RRSP in order to make the deduction. So even though you calculate your RRSP deduction limit to be 15,000, you actually have to put the 15,000 into an RRSP that you set up with a bank or financial institution in order to make the deduction. So that's sort of the first term that we need to be aware of, is that when we calculate that formula, that's the maximum RRSP deduction for the year, once again, provided we make contributions. Now, to that number, we could add what we call this cushion. And the cushion is basically an additional $2,000. And if we add this cushion of $2,000, whoops, that's going to give us $17,000. This $17,000 is known as the non-penalty contribution limit. So what that means is if you put a little bit more than 15,000 into an RRSP, as long as it's no more than 2,000 over, you're not going to get penalized. Because remember, the money you put into an RRSP that's going to grow tax-free until you take the money out. So there's a benefit of trying to put more in than you're allowed to. So you can put up to $2,000 more, but once you hit over that $2,000 cushion, then you will be penalized 1% per month that you're over this non-penalty contribution limit. So always should sort of be careful is that you calculate your RRSP deduction limit, you put in a little bit more, as long as it's not over the $2,000 cushion, then you will not be penalized. So that's sort of another term that's talked about in the textbook is this non-penalty contribution limit. But once again, you still need to put money into an RSP in order to get the deduction. So then let's talk about the contributions. Let's say this taxpayer will contribute 16,000 into their RRSP. So they actually put 16,000 in because remember they can only deduct 15,000, but because of this $2,000 cushion, they can put in a little bit more without getting penalized. So they decide to put in 16,000. So what that means is that the taxpayer will then have a 3C deduction of $15,000 because they actually put that money in, and they can actually use that 15,000 to reduce their net income for 2023. Now, you don't have to make this deduction if you don't want to. Let's say that you knew that next year, 2024, you were going to be in a much higher tax bracket. So, but you still want to put the money into the RSP because then it will grow tax-free. But let's say you knew that next year you're going to be in a much higher tax bracket, then you could deduct anywhere from 0 to 15,000. You don't actually have to make the deduction if you don't want to. So let's say you deduct, let's say 0, then you can sort of save that deduction all for next year. But once again, it's not wise to save the deduction for a future year unless there's going to be sort of a huge tax advantage. So most of the time, if you do make the contribution, then you will sort of make the deduction that you're allowed to as well, just because it just gives you that tax savings this year rather than have to wait for another year to get that reduction in your net income. Any questions about 2023? So the $2,000 cushion is not deductible. So just to sort of get to Hayden's question, the maximum you can deduct is 15,000. So once again, even though this taxpayer contributed 16,000, the maximum they can deduct is only 15,000. That's the maximum. They cannot deduct any more. So if they put 17,000 in, they can only still deduct 15,000, but they can put in an extra 2,000 without getting penalized. So then let's sort of talk about what happens next year. So in 2024 then, what is our A amount? Well, our A amount is 0 because we used up all the deduction last year. So the A amount would be 0 for next year. Just hold on a second here. Then we get, oh, one thing I want to sort of mention is that we contributed 16,000, but once again, we can only deduct 15,000. So next year, we will have 1,000 of what we call undeducted contributions. So we made 16,000 of contributions last year. We only deducted 15,000, so we still have 1,000 of contributions that we haven't deducted, and that will sort of carry forward. So that's one amount that will carry forward. But in terms of our deduction room, we were allowed to deduct 15. We deducted 15, so the deduction room carry forward is 0. Now, just to sort of make this easier, let's just say the B amount was 6,000. So I'm not going to go through the calculation. Let's just say the B amount was 6,000. And so A plus B, R and C are 0. So then once again, if we work through the simple sort of calculation here, the maximum RRSP deduction for 2024 will just be $6,000. So once again, fairly straightforward. And then let's say this year, we didn't have a lot of extra money. So we only contributed $3,000 this year. So $3,000 of contributions in 2024. Now our total contributions though will be 4,000 because remember we had 1,000 carried over of undeducted contributions from last year. So we will still have 4,000 total contributions sitting there. So let's say then we're left with this situation. The maximum RRSP deduction is 6,000, but we only have 4,000 of contributions because we didn't have enough money to bring it up to the full 6,000. So what that means is that the maximum pre-C RRSP deduction will only be 4,000 because that's all we have in contributions. And so let's say we make that maximum contribution of 4,000, and then the amount that will carry over to next year will be 2,000. So 2,000 of the RRSP deduction room will carry over to 2025. So we were allowed to deduct 6,000, but we only had a total of 4,000 in contributions. So we only could deduct 4,000 this year. And so 2,000 will carry over to 2025. And so for 2025, the A amount will equal to 2,000. Now, because we are deducting the full 4,000, we will have 0 contributions moving into next year. So there'll be 0 in undeducted contributions for 2025. So I just wanted to sort of give this simple example because there's sort of a difference between sort of your stream of deduction calculations, and then there's sort of a difference in all your contributions that you make, and whether there's sort of any amounts that carry forward as well. So I just wanted to sort of get this simple example done first, just so we have a basic understanding of sort of the difference between the unused deduction room that carries forward and any sort of undeducted contributions that carry forward. Any questions about this simple example first? So this definition of earned income is fairly detailed. So 18% of last year's earned income. So what is included in earned income? So once again, employment income without the deduction of the RPP, business rental income, also any sort of business income earned through a partnership. If you earned any royalties, so royalties are usually paid if, for example, you write a song, you write a book, every time the song is sold or the book is sold, you get a royalty. And so as long as you are sort of the author or inventor or composer of the work, then that royalty would be included in earned income. If you receive any spousal support, you include that as well. There's a few extra other things that are talked about here, but you don't really see those that often. But also with earned income, there's also amounts that you have to deduct. If you paid any spousal support, that would reduce your earned income. If you have any losses from businesses or losses from rental property, that would also reduce your earned income. So this is the definition for earned income that we use when we calculate that B item in that formula. But we always use last year's earned income to calculate this year's RRSP deduction. So we're going to use this definition moving into this first problem that we're going to do. So this is the taxpayer that has primarily income from employment. And once again, we're looking at last year, 2023, because last year's income will be used for this year's RRSP deduction. So we have his salary. He also earned commission. He also had taxable employment benefits. So that could be like those stock option benefits that we talked about in chapter 3. He also put money into company RPP, 2,000. His employer also put 2,000 in as well. And then his employer also made a $1,200 contribution to a DPSP. So this DPSP, let me just sort of make some notes here, stands for, what does it stand for? Defined Deferred Profit Sharing Plan. Deferred Profit Sharing Plan. So this is also another sort of company-sponsored pension plan, but it's usually sort of geared towards senior executives. So if you look at the term, the name, Deferred Profit Sharing Plan. So basically, it's not the same as an RPP. An RPP is usually given to all employees, and it's usually based on sort of set numbers. The maximum that the employee can put in might be a percentage of their salary. And then there's a formula as to how much the employer will put in. It could be dollar for dollar. It might be a percentage. And so the RPP amounts are usually set year to year. But a deferred profit sharing plan is not set every year. And it's sort of, if you think about the term, it's basically sharing the profits. So if there is a year where there's little profit or no profit, there's a loss, then the company doesn't have to put money into this employee's deferred profit sharing plan. And with a deferred profit sharing plan, only the employer will put money in on behalf of the employee. So the employee doesn't have to put any money in to a DPSP. But the only reason that this is important is that this is basically another company-sponsored pension plan. So all these amounts, the 2,000 that he put in, the 2,000 that the employer put in, plus the 1,200 that the employer put in to this other pension plan, that will total the pension adjustment for 2023. And so the pension adjustment for 2023 is going to be $5,200. So that's why those numbers are important. He also has interest income, dividends, royalties, taxable capital gain, bunch of losses, rental loss, allowable capital loss, also a loss carryover from 2021. He also has custody of his 7-year-old son, and he receives $14,400 in child support payments. He also receives $9,000 in spousal support, and he also paid $4,000 in childcare expenses during 2023. Now, he also has a sort of a second marriage that he got divorced as well. And in that second marriage, he's now paying $2,500 a month in spousal support. So this $14,400, that's what he receives. This $9,000 is what he receives, but this $2,500 a month is what he pays. At the end of 2023, this was the amount of unused RRSP deduction room. So that's going to be our A amount for 2024. And he also has $21,000 in undeducted contributions. So in 2023, he calculated his RSP deduction room. That was $23,000. He made $21,000 of contributions. And for whatever reason, he decided not to claim any RRSP in 2023. And like I said, usually you wouldn't do that. The only reason you might do that is that if you were maybe in a really low income year in 2023 and that deduction would not help you very much, then you may not make the deduction in 2023. And couple that with maybe 2024 is going to be a really high income year. That could be a reason why he didn't make any RRSP deduction for 2023. Now, what they want us to do first is to calculate his 2023 net income for tax purposes. So this would be a bit of a good refresher about how to calculate net income for tax purposes. But once again, what we're mostly after is we want to figure out what his earned income is for RRSP purposes. But let's just start with part A first. Calculate his net income for tax purposes. So in 3A, we're going to have his net employment income. Now, his net employment income, if you look at the numbers there, we have the 66,000, we have the commissions of 16,000, the taxable benefits of 8,000, and then we minus his contribution to the company RPP of 2,000, and his net employment income, if we work through those numbers, that should be 88,000. Let me just double check that. Yeah, that's going to be a total of 88,000. And then he also has interest income. And so that's going to be included in 3 as well, 3,400. And then he also has some eligible dividends. Now, remember with eligible dividends, we have to gross them up. So the actual amount is 1,900. For eligible dividends, the gross up is 38%. And so 38% of 1,900 is going to be 722. And so the taxable or gross up dividend is going to be 2,622. Royalties are also included in 3A. So royalties are basically, once again, monies earned from this book that he was the author of. So every time the book is sold, he earns some royalties. So that's also included in 3A, 6,500. And then remember last week we said that if you receive spousal support, you are taxed on that. Child support is not taxable, but spousal support is. So that would be included in 3A as well. And then we move to 3B. 3B is the excess of the taxable capital gains over the allowable capital losses. And so once again, wording is important. They give us the taxable capital gains and the allowable capital losses, so 38,000 and 9,000. And so the 50% has already been applied. If they gave us capital gains and capital losses, we would have to multiply by 50%. But because they give us the taxable amounts and the allowable amounts, the 50% has already been applied. And so the 3B amount then will be 29,000. Let's just do a quick subtotal for 3A. And then we get to our 3C amounts. And once again, we were told that the RRSP deduction was, he didn't claim an RRSP deduction. There's moving expenses, but there's no moving expenses in the question. There's childcare costs. Now, remember last week we talked about the childcare cost was the lesser of those 3 amounts. We're not going to go through that calculation. We'll just accept that the 4,000 that's given to us is the lesser of those 3 amounts. Also, spousal support paid. And so he paid spousal support. And the amount that he paid was 2,500 per month. So right down here, 2,500 per month times 12 months. That's going to be a total of 30,000. So another 3C deduction of 30,000. Oh, that's not. And then we finally get to 3D. 3D. This is where the rental loss comes in. And so the rental loss is 10,400. Now, if we take a quick look at the information that's given to us, this net capital loss balance, this net capital loss balance of 32,000, that's a deduction when we calculate taxable income. Remember loss carryovers? We deduct those when we calculate taxable income, but the question is just asking us to calculate net income. So we're not going to make that deduction when we calculate net income for tax purposes. So generally, that would be the calculation for net income. The only other thing that is missing is in 3C. And you may remember this from chapter 4. In chapter 4, we talked about the CPP deduction. And we said that if you contribute the maximum in CPP in a particular year, most of it goes to a tax credit multiplied by 15%. Those tax credits we talked about in chapter 4. but a small amount will be a 3C deduction. Let me just bring up the rates table. Now, keep in mind, we're looking at 2023, not 2024, but let me just bring up the 2024 rates table first. If we take a quick look at the 2024 rates table, it'll come up in a second. We'll scroll down to the CPP amount, and it's right here. And if you look at the last sentence, or the last line, it says, the CPP net income deduction is equal to $838. So in 2024, if you contributed the maximum to CPP, the credit amount would be 3218, and the 838, the difference of the 4,056, which is the maximum that can be taken out, and the tax credit amount of 3218, that difference of 838 is a 3C net income deduction. Now, for 2023, the amounts are different. So you don't have the 2023 rates table, but so I wouldn't sort of worry about it. But the reason I'm just sort of showing you this is because they may come up in some of those, self-study problems. Let me just switch over to the 2023 rates table. So I just did a quick switch to the 2023 rates table. So this is, if you see it at the top here, this is the 2023 rates table. And if I scroll down to the same CPP right down here, that last sentence, the difference of 631 is a net income deduction. So the CPP deduction under 3C for 2023 is 631. And so the reason I'm showing this is that because his employment income was relatively high, he would have hit the maximum CPP. If we sort of see here in the second row here, the maximum CPP is based on earnings of 66,600. So as long as he had 66,600 basically in employment income, he would have hit the maximum CPP for 2023, and therefore 631 would be a 3C deduction. So I just wanted to sort of show you that because in the solution, they do deduct the CPP amount. And once again, I just want to sort of share that with you, just so that when you do sort of start going through the self-study problems, that if you are looking at the 2023 year, that CPP deduction is going to be 631. Any questions about that? So let's just sort of figure out what is his net income for tax purposes. So equals sum of, so all these amounts here, and then also plus the 3B amount, which is 29,000. So we get net income for tax purposes of 93,491. So I just wanted to sort of go through this with you. This is a bit of a refresher of some of the concepts we've learned from earlier chapters, and that's sort of part A of this question. Now we move on to part B. So what does part B say? Based on the information, calculate his maximum contribution and his maximum deduction. And so the maximum deduction is based on that formula, the A plus B plus R minus C. And then we'll talk about the maximum contributions as well. But let's start with the maximum RRSP deduction. We'll use that formula first. So remember, the A amount is 23,000, but he also has undeducted contributions of 21,000. So let's go to part B here, and let's set this up. So we know that the A amount is going to be 23,000, but he also has 21,000 in undeducted contributions that carried over to this year as well. Then we get into the B amount. B is equal to the lesser of 1, the set amount, that 31,560. Now, I forgot to show you when we have the rates table up here, I forgot to show you where the RRSP formula is. Let me just do that before I forget. So I go back to the rates table, and bring up the 2024 rates table. Let me just scroll over to the 24, just to make sure. Yeah, this is the 2024 rates table. We'll scroll down page 2, page 3, page 4, page 5, right at the bottom here, chapter 10, RRSP deductions, right down here. So once again, lesser of 31,560 and 18% of last year's earned income, reduced by last year's pension adjustment. So that's sort of where it is in the rates table. It's also provided in your textbook as well. So if we go back quickly to the Excel spreadsheet, B is the lesser of that 31,560 and 18% of last year's earned income reduced by last year's pension adjustment. Now, the pension adjustment we already calculated. Remember that pension adjustment? Those were all the amounts that were contributed to the company-sponsored pension plans. That pension adjustment right up here, 5,200. So let's just put that down before we forget. Last year's pension adjustment is 5,200. So what we need to do then is figure out what was last year's earned income. So let's then look at his income and also the definition. So employment income computed without the employee RPP contributions. So it's going to be that 88,000 employment income, and we're going to add back the 2,000 that he put in. Now, he does have royalties. So the royalties from the book that he wrote, we have to add that. He does have spousal support. So that 9,000 in spousal support received, we have to add that as well. He did pay spousal support. So the 30,000 in spousal support he paid would reduce his earned income. And he did have a rental loss. And so the 10,400 rental loss would be deducted as well. So let's just look at his income calculation here. And we'll just sort of do it here. So the 2023 earned income will be comprised of the following amounts. So it's going to be the employment income, the 88,000, but without deducting the 2,000 RPP. So we're going to add that back. So that's going to be 90,000. We have the royalty. So the interest does not count. The eligible dividends do not count. The royalties do. That's going to be the 6,500. The spousal support received, the 9,000 is included. The spousal support paid, we deduct, and the rental loss, we deduct as well. So passive amounts such as interest income, the dividends, those passive amounts are not included in this earned income calculation. So if we quickly add up the earned income for last year, we're going to get 65,100, and that's the number we will use in the calculation for the B amount. So 18% of last year's earned income. Last year's earned income was 65,000, so 65,100. And if we multiply that by 18%, we should get 11,718. So the B amount is the lesser of 31,560 and 11,718. That's going to be 11,718, reduced by last year's pension adjustment. So basically our B amount will equal 11,718 minus the 5,200. So the B amount is going to be 6,518. And once again, R and C are going to be 0. Once again, those rarely show up. I'll explain what that is later. But if we work through the math, the maximum 2024 RRSP deduction limit, basically the A plus B, 23,000 plus the 6,518, we're going to get 29,518. Now, once again, if the question was asking, what is his maximum contribution without penalty, then we would add this $2,000 cushion of 2,000. And so this would be what they refer to as the non-penalty contribution limit. So the maximum he could have in contributions would be 31,518. So he already has 21,000 in undeducted contributions. And so let's just sort of go back and see what the question is asking and see if we can sort of answer the specific questions. So the maximum RRSP deduction limit, that's the 29,518. They also asked, what is the maximum contribution that he can claim for 2024 without incurring a penalty for excess contributions? So it's kind of a, I don't know, to me it's kind of poorly worded. It's maximum contributions that he can claim. So the maximum contributions that he can have at any point in time for 2024 is 31,518. If he has already 21,000 in contributions sitting here, the additional contributions that he can make would just sort of be the difference. So we take the 31,518 minus the 21,000. Well, this would be sort of the additional contributions he could make in 2024 without incurring a penalty. So let's just sort of stop here for a second. Any questions at this point? So let's just sort of talk about what would happen if he does not make any more contributions. If he does not make any additional contributions in 2024, the maximum free CRRSP deduction will be 21,000. In order to deduct this amount, 28,518, he needs to have that amount in contributions. Currently, he only has 21,000 in contributions, and there's no indication that he's making any additional contributions this year. So if he does not make any additional contributions, the maximum that he can deduct for 2024 would just be 21,000. So if he wants to deduct 29,518, he would have to make additional contributions equal to 8,518, which is basically the 29,518 minus the 21,000 of undeducted contributions. So that's sort of how you would sort of interpret all those numbers. If you wanted to make the maximum 29,518 3C deduction, he would still have to make additional contributions of 8,518. Any questions for part B? So let's go to part C. Part C says, assume that in addition to the information above, he also had 2023 business income of 160. So that business income, if we go back to the definition of earned income, that business income would increase his earned income. So that's what they're saying is that, let's just say in addition to all the earned income that he had, we're going to add now an additional 160,000 in net business income. So let's just sort of take all this here. Let's take all this here, go down to part C. And then we will add 160 in business income. And so that's going to give us a new earned income of 225,100. So this will be his 2023 earned income. And so they basically just want us to figure out how that will impact his RRSP deduction for 2024. So that's the only thing that's going to change. So then what we can do then is just go back up here and sort of copy this information. We'll update what changes. So let me just add some rows here. We'll update what changes. Hold on. Copy that again. So we'll just update what changes here. So the one thing that changes, it will be his earned income. So I'll update the earned income amount. It's not going to be 65,100. It will now be 225,100. And so 18% of that number will now be 40,518. So we still have the same amount that carried over from last year. B is the lesser of the set amount that's given by the government at 18% of last year's earned income, which is now higher. So then if we think about the lower number between these two, the lower is going to now be the 31,560. We also have to reduce it by last year's pension adjustment. So now the B amount will be 31,560 minus, oops, oh, sorry, goes 31,560 minus 5,200. It's going to be 26,360. And so all that's sort of showing you is that if your earned income exceeds a certain amount, then the lesser amount is going to be 31,560. And what we can quickly do is try to figure out what is sort of the threshold. If we take the 31,560 and we divide it by 18%, let's just sort of see what that gives us. We're going to get 175,333 rounded. So what that basically means is that once your earned income hits over 175,333, the lesser amount is going to be the 31,560. So, sometimes if you're let's say operating a business. So let's say you're operating a business, and you're trying to figure out how much to maybe it's a corporation, maybe you have your own corporation and you're paying yourself sort of a salary. So you're paying yourself a salary, you're an employee of this corporation that you own, and you want to maximize your RRSP, deductions for every year. And so some owner-managed businesses will pay themselves up to this amount just to get their maximum RRSP deduction limit. So that's sort of what some owner-managed business owners do, where they have this corporation, they're the owner, the shareholder, but they're also an employee, and they pay themselves a salary for working in that corporation, and they sort of figure out what's sort of a good number to pay myself. If they want to maximize their RRSP deductions, then they'll sort of figure out what is the RRSP limit for the year. Divide that by 18%. And then if they pay themselves this amount of salary, then that will maximize their RSP deduction for that year. But anyway, getting back to this question, if we work through the A plus B plus R minus C, the A is 23,000, the B is 26,360, and so the maximum 2024 RRSP deduction will basically be the 26,360 plus the 23,000, and so 49,360. So I just wanted to sort of illustrate that to you. The increase in earned income does increase your RRSP sort of deduction limit, but only to sort of a certain point. Questions before we move to the next topic? I want to explain what the R and C are. So we go back to the formula here. The R is a plus and the C is a minus. So what is the definition? The definition of the R and C, if I sort of go back over here. So R is a plus. The pension adjustment reversal, so that's a plus. And then a C is a minus, is past service pension adjustment. So both the C and the R all relate to pension adjustment. Remember, pension adjustments are the amounts that you and your employer put into the company-sponsored pension plan. The R will increase your own RRSP deduction limit. The C will reduce it. So let's talk about the C first. So let me just, why don't I do it over here? I'll just do it right here since we're looking at this formula here. So remember, let's talk about the C. So it's minus C. And the C amount is what the past service pension adjustment. So remember, the pension adjustment in B reduces it as well, but that was sort of last year's pension adjustment. This is a pension adjustment based on past years of service. So let's just go through a simple example. Let's say you started working for the company in 2019 and you decided not to join the pension plan. You thought, I'm only going to be here for maybe a year or two, so I'm not going to bother joining the pension plan, because if I quit next year, then I've got to figure out how to sort of transfer the money out, just sort of too much work. But let's say in 2024, you're still working for the company. So you join the company's RPP. Now, some companies will allow the employee to buy back service. And so let's say that you then will contribute to the RPP for the 2019 to 2023 years. And so let's say you put in 10,000. And then, so this is how much you contribute. And then let's say your employer also contributes, let's say they contribute 5,000. So let's say they don't match it dollar for dollar, but just 50%. Then this 15,000 would basically be the C amount, because it relates to previous years, not specifically sort of just last year, relates to sort of prior years. And so that's basically what the C amount is. And once again, the questions in the textbook, I kind of reviewed most of the RSP questions in the textbook, and most of the questions don't even include any of the C or R amount. So I wouldn't sort of worry about these for exam purposes as well. but I just wanted to explain what they are, just so you have an understanding of what the C and R amounts are. And even in real life, you don't really see them that often. So it's kind of rare that you would see the C and the R amounts. It does happen occasionally, but not very regularly. So that's the C amount. What about the R amount? R is a plus R, pension adjustment reversal. So let's talk about plus R. So let's just use a different example. Let's say it's 2022 and you join the company RPP. And so RPP, and so let's say you put in 1,000. Oh, 1,000. And then let's say your employer puts in 500. And so for the 2022, this would be your 2022 pension adjustment. And so that would come into play in 2023. So in 2023, when you're doing your B calculation, you would minus the 2022 pension adjustment of 1,500. So the B amount, you would minus this amount here. So minus meaning that it reduces your B amount, your overall RSP deduction limit for 2023. That's fine. The only thing about this employer portion here is that usually there's what we call a vesting period. So there's 500 here. There's usually what we call a vesting period. And it changes from employer to employer. But basically what that means is that if you quit before vesting period over, you do not get this amount. The 1,000 is yours. So this 1,000 basically is your even if you quit, you take your contributions with you. So often with a company-sponsored pension plan, it might be administered by like a company like Manulife. And so even if you quit, the company's sponsored pension plan is with Manulife, you just sort of transfer that sort of into sort of your own account with Manulife, and it can just sort of be done tax-free. So the amount that you contribute to a company RPP, that's yours. Even if you quit, that will still be yours. But the amount that the employer puts in, there's usually a vesting period. For example, it might be, let's say 4 years. I'll just sort of put that here. E.g., let's say it's going to be 4 years. Some companies, it might be a little bit less than that. I think when I was working at KPMG, it was maybe 3 or 4 years. So there's sort of this vesting period. So in 2022, your employer put in 500, your pension adjustment for 2022 was 1,500. And so when you calculated your RRSP deduction limit for 2023, you minus that 1,500 in your B calculation. And let's say in 2024, you quit. And so then you have to return the 500 to your employer that they put in. So then in 2024, the R amount is going to equal 500. Remember, it's plus R, right? So the R amount is plus R. And so that's going to now increase your RSP deduction limit by 500. You reduced it in 2023, but in 2024 you quit and you have to give back this 500. So then you will get this plus R in 2024 when you calculate your RSP deduction limit. Questions about the R amount? So you put all this money into an RRSP, and now you've got to take it out. And so when you take it out, let's just get down to where we are. You can basically take out sort of lump sums at any point in time. There's no need to wait until you retire. But the thing is, once you take the money out, it's added to your net income for the year that you took the money out. Now, there are some exceptions we'll talk about, but you put the money in, you get a 3C deduction, you take the money out, you add it to your net income in 3A. There is withholding tax though. Since you are having to pay tax on that money, the government says if you take money out of your RSP, the bank or the trustee, whoever is sort of looking after the plan, will have to withhold taxes and send that into the government and give you the net amount. So let's say you take out 20,000 from your RSP. How much withholding tax does the bank need to withhold based on this amount here? If you take out 20,000, they're going to withhold 30%. If you take out 5,000 or less, they're only going to withhold 10%. If they take out over 5,000 but less than 15 or up to 15, they take off 20%. So on this 20,000 that you withdraw from your RSP, the trustee is going to withhold 6,000, send that into the CRA, and that's going to be sort of a prepayment for your taxes for the year. So you will just get 14,000 in cash, but you will have to add 20,000 to your net income for the year. Just like with working for a company, your gross pay is 5,000, but your employer has to take off EI, CPP, income tax, and then they give you the net amount, but the gross amount is what you include in your net income. So the 20,000 you include in your net income. The 6,000 they send to the CRA as a prepayment for your taxes, and then the actual cash you're going to get is 14,000. Then we move on to this concept of spousal RSP. A spousal RSP is money that you put into an RSP that is in sort of your spouse's name, but it's based on your RSP deduction limit. So let me give you an example here. Let's say Ruth and David are married. And let's say Ruth works full-time and David does not work. So David does not work, so no earned income, and so no RSP. Remember, you need to have earned income in order to be able to put money into an RSP. If you have no earned income last year, your RSP deduction is going to be 0. So let's just look at this if Ruth was just to put all the money into her RSP. Let's say for 2024, Ruth does her calculation, A plus B plus R minus C, it's 20,000. And she contributes 20,000 all to her own RSP. So it's just going to be put into her RSP. And let's just say for simplicity's sake, Ruth works 40 years times 20,000 per year for her RSP. And so at the end of 40 years, she's going to have 800,000. Now there will be accumulated sort of earnings as well. And so what I mean by that is that obviously when you put money into an RSP, you're going to invest it. It's going to invest in exchange traded funds, mutual funds, stocks, term deposits. So there's going to be all this accumulated earnings. So it's not just going to be the 800,000 that she put in, but it's going to be a bunch of accumulated earnings as well. And so let's say now they're going to retire. So at retirement, let's say Ruth and David need, let's say, 60,000 a year. So Ruth withdraws 60,000 from RSP, and that is added to her net income, and she pays tax on that. Now, once again, there's going to be withholding tax, but all that 60,000 that she withdraws will be subject to tax. So this is a situation where she does not use a spousal RSP. Let's just sort of see what would happen and why you would use a spousal RSP. A spousal RSP basically can be set up in the name of David. So we have Ruth here, and so she can contribute. So Ruth could contribute up to 20,000 per year. And what she could do then is set up her own RRSP and maybe put in 10,000 a year times 20 years. Oh, so we have 40 years, not 20 years. And so we'll have 400,000. And then what she could also do is use this 20,000, put 10,000 into her own, and then put 10,000 into a spousal RSP in the name of David. So she would still get the $20,000 deduction. So that 20,000 is based on her earned income. So she would get the deduction of 20,000 every year. But what she could do is put some of it into her RSP under her own name and some of it into a spousal RSP that's in the name of her spouse. But it's based on her numbers. It's based on her maximum deduction amount. It's not based on David at all because David doesn't work. David has no income. Even if David had income, she could still put money into a spousal RSP using sort of her money and her limit and just put it into an RSP in David's name. And the benefit of doing that is that when they retire, they want to withdraw again 60,000 total. So basically 30,000 each. And so what will happen is they'll pay overall less tax because Ruth will only include in 3A 30,000 and David will once again in 3A only have to include 30,000. And so remember those rates that we were looking at on the rates table? The higher your income is, the higher your tax rate is. If all the RSP was put into her name, she would pay more tax because the 60,000 would result in a higher tax bracket. But if you put some of the contributions into her spousal RSP in the name of David, and then they both sort of withdraw money when they retire, they would pay sort of less tax overall. So that's sort of another sort of tax saving method is if, let's say, you have a couple, one is sort of a high income earner and the other one, you know, doesn't have much in RSPs, then the high income earner could figure out their RSP deduction limit, make the contribution, but split it up between their RSP and RSP in their spouse's name. Any questions about the spousal RSP? Now, there is a rule, though, that talks about attribution. And as you can sort of see that if Ruth was to put the money into a spousal RSP for David, and David does not work, he could take the money out that next year and not pay any taxes. Because remember the basic personal amount, 15,700 and something? He could take that money out and not have to pay any tax on it because of the basic personal amount. So we have this attribution rule. So let's look at this new example. Let's say Ruth puts money into a spousal RSP in her husband's name, David. So the amount that she puts in to the spousal RSP over these 5 years are these amounts. And let's say in 2024, David wants to take $10,000 out of his RSP, the one that was set up by his wife. So David would normally have to include that 10,000 in his income. But because of this attribution rule, some of that 10,000 may be attributed back to Ruth. And so what does the rule say? The amount that will be attributed back to Ruth will be the lesser of the amount that was withdrawn, 10,000, and the spousal RSP contributions that were made in the current year. So this is 2024. The current year was 1,500, and the preceding 2 years, 4,000 and 2,500. So current year, 1,500. Preceding years, we have 4,000 plus 2,500. And so the total of the second number is going to be 4,000 7, 8,000? Yeah, 8,000. So the lesser of the two amounts is going to be the 8,000. So even though they thought all of it would be taxed under David's name because he's in a lower tax bracket, Ruth will have to include in 3A 8,000, and David will only be including 2,000, the remainder. So this is sort of this attribution rule that couples have to watch out for, is that if they put money into a spousal RSP, the spouse whose name is in the spousal RSP has to be careful if they take money out. Some of that could be attributed back to the other spouse, usually the higher income spouse. Questions about the spousal RSP attribution rule? What is that? 7:16. Why don't we take a short break now? Any questions before we stop for a short break? 7:16. Why don't we come back then in 10 minutes? We'll come back at 7:26. Okay, take a short 9-minute break and I'll see you back here at 7:26. We're now going to continue with the next part of chapter 10, which talks about the home buyer's plan. So this basically allows an individual to withdraw up to $35,000 tax-free from their RRSP in order to buy a home. Now, there's sort of certain rules about this withdrawal. It's $35,000 per individual. So let's say you have a couple and they both have separate RRSPs, then the total could be 75,000. So quick question before we continue. Do the spousal attribution rules stop applying when contributions end? So just to sort of look at the question that Hayden put in, there's sort of this 3-year window. And so let's just sort of go back to this example here then. So let's say these are the contributions that Ruth makes into the spousal RSP for David. So let's look at sort of a new example. Let's say we have a new example here. And let's say David then withdraws, let's say 10,000, but in 2027. And so once again, the amount attributed to Ruth will be the lesser of the amount withdrawn, which is the 10,000, and then the contributions in the current year, which would be 0, and the last 2 years, so that would be 2026 and 2025, and that would also be 0 as well. So I think this is sort of getting at the question that Hayden was answering. They still the 3-year look back, but if there's no contributions in the current or the last 2 years, then there would be no further attribution. So then in this example, Ruth would have 0 income, and then David would have to include the full 10,000. I think that's sort of what you're asking, Hayden. Does that answer your question? Perfect. Yeah. So then let's go on to the home buyer's plan. So if you withdraw the money, then basically it can be up to 35,000, but it doesn't have to be the full 35,000. But once again, it's per individual. So if you have a couple and they both have quite large RSP balances, each could take out 35,000, then it would be 70,000 going towards buying a new home. So the proceeds would be used to buy or build a home to reside in. So you can't take the money out to buy a rental property. It has to be money that you take out to buy or build a home that you're going to reside in. So let's say in 2023, Ruth takes out 15,000 from her RSP and she tells her bank this is under the home buyer's plan. So if you say that it's under the home buyer's plan, there's some forms that you have to fill out. And then the bank then will not withhold any taxes. And when you go to file your tax return for the year, you don't have to include it. You do not have to include it in your net income for tax purposes. So there's no withholding tax, and you don't have to include it in your net income for tax purposes as long as it qualifies as a withdrawal under the home buyer's plan. But there's sort of a time limit. If the withdrawal is made in 2023, then by October 1st of the following year, Ruth must have bought or built the home. So there's sort of this window where by October 1st of the following year, the home would be purchased and then she would be living in the home. Now, the money that is taken out of the RSP must be repaid, but it will be starting in the second calendar year. So if the withdrawal was made in 2023, 2024 would be the first calendar year. 2025, the repayments would have to start, but she could start paying it back sooner if she wanted to. The repayments are over a 15-year period done on a straight line basis. So what that means is that for 2025, we would take the 15,000, divide it by 15 years. And so it would be basically 1,000 would be the minimum repayment. And so let's just sort of keep track of it here. So we have 15,000. And let's say the amount that is repaid is actually $1,000. So then the balance going into 2026 is 14,000. Now it's done on a straight line basis. So all we would just do is take the balance that's remaining, divide it by the remaining years, which is 14. And once again, we get the $1,000 minimum repayment. Now you can pay back more if you want. So let's say in this year, Ruth repaid 5,000. So then the balance going into 2027, let me just get rid of some lines here. So the balance going into 2027 then is 9,000. 9,000. So then we get to the 2027 year. So then we take the balance, 9,000, divide it by the remaining years, 13 years. And so the minimum repayment is 692. So if you pay back more than the minimum, then you basically have to recalculate the minimum repayment amount starting in the next year based on the number of years remaining. So you can pay back more, but what if you pay back less? Let's say that you only repay 500. So the minimum repayment is 692, and let's say 500 is the amount actually repaid. So then we have to sort of look at the difference here. The difference is 192. Because you did not pay the minimum amount back, you paid less, this 192 would be added to 3A as income. So if you don't pay back the minimum amount, the difference will be added to 3A as income. And you will get credit for it though, because you are now going to have to pay tax on it. So you will get credit for the 192. And so basically it will be as if you did repay the full minimum amount, because you will get credit for the amount that you underpaid. And so in 2028, the balance remaining will be 9,000 minus the 500 minus the 192 will be 8,308. So it will be like you did repay the 692, but part of it will be added to your income and you have to pay tax on it. And so then starting in 2028, we then once again take the balance, 8,000, 308, divide it by the 12 years. And so we're still going to get 692, right? Because last year it was as if you did repay 692, you got credit for the 192. So the minimum repayment going forward will still be 692. Any questions about the home buyers plan? So then there was something new that came into effect in 2023. So this is new. This was sort of introduced new as of 2023. It's called the tax-free first home savings account. And so this was sort of a new incentive that the government introduced in 2023, was again just trying to help Canadians sort of save for a home, because home prices are so expensive, especially sort of in the big cities here in Canada. This is sort of another way to help Canadians save to buy their home. So this is a new account. This is not the tax-free savings account. This is not RRSP, but it's similar to a tax-free savings account, because if you see here, it does have the words tax-free savings account. But the only thing that's added is it's for your first home. So if you're 18 or over and you do not currently live in a home that you owned or in the preceding 4 calendar years, and that's the same thing that applies for the home buyers plan as well. You can't, so for the home buyers plan, you can't already be living in a home and then take money out to buy another home. So if you already are living in a home, then you cannot access money under the home buyers plan, or you cannot have lived in a home in the last 4 years as well. So there's sort of this time period where if you had a home, you sold it for the 4 years after, you can't access the home buyers plan under your RSP, and you can also not set up this tax-free first home savings account. What this tax-free first home savings account is that it allows each Canadian 18 or over to contribute 8,000 a year up to a 40,000 lifetime maximum. So if you contribute 8,000 a year maximum, and you contribute for 5 years, that's your 40,000. So basically it just says that if you have enough to put in 8,000 a year and you do it for 5 years, then you've hit your maximum. The contributions are deductible. So it's similar to an RRSP in that respect, that the contributions are deductible. That's different from a TFSA. Last week when we talked about TFSAs, if you put money into a TFSA, you can't deduct the contributions, but when you take the money out, it will be tax-free. This tax-free first home savings account is kind of like the best of both, the best of an RSP. You do get the deductions. Also, the earnings accumulate tax-free. And then when you take the money out, it's not included in income. But once again, the money taken out must be to purchase a home. So once again, there's sort of penalties. If you do take the money out and you don't purchase a home, there's sort of penalties that are incurred. But this allows Canadians that are 18 and over to start putting money into this account. They get a deduction, which is good. It reduces their income, reduces the taxes they pay. All their earnings within the plan accumulate tax-free. And then when you take the money out and you use it to buy a home, you don't have to include it in income. So it's a relatively new, like I said, it's new as of 2023. Because it's relatively new, I will not examine this. So this will not be examined on the final exam. It is sort of a relatively new sort of savings vehicle. So you can sort of read up on it on page 611, 612, if this is something that you think you might want to start opening up when you start working. But once again, relatively new, will not be examined, but definitely sort of a good way of saving for your first home that will sort of have quite a good tax benefits. Let's talk about RRSP termination. So you put money into an RRSP while you're working. That's sort of the general, what most people do. And then when you start thinking about retirement, this is sort of where you start thinking about taking money out of your RRSP. Now, there's a rule that says in the year that you turn 71, your RRSP must terminate. And so what that means is that when you're 72, you can no longer have an RRSP. But once the money comes out of your RRSP, then it's all taxable. So that's not good. But what a lot of Canadians do is they will transfer the RRSP into a RRIF, a Registered Retirement Income Fund. So let's sort of talk about the wordings here. An RRSP is used for savings. So that's why in the year that you turn 71, you must terminate the RRSP because you should no longer be in that savings sort of period. Now it can terminate earlier. You can basically terminate the RRSP earlier than age 71, but no later than the year you turn 71. That's the year that it has to be terminated. Now, because it would be it would not be practical to have all that money come into your income when you terminate your RRSP, most Canadians then will transfer the money into a RRIF, a registered retirement income fund. So if you look at the wording of the RRIF, it basically has the word income. This is where you have to start taking money out. You can't delay deferring tax forever. Once the money comes into a RRIF, there's a minimum amount that must be withdrawn annually. And that starts in the year, starts in the following in the year the RRIF was established. So if you establish the RRIF this year, in the following year, there's a minimum amount that must be taken out. Now you can take out more than the minimum, but you need to take out the minimum. And that minimum will change every year. The way the minimum is calculated depends on your age. If you are under 72 at the beginning of the year, then you use this formula. You take the value of your RRIF, divide by 90 minus your age. If you are 72 or older, then you take a certain percentage multiplied by the fair market value of your RRIF. Now, this specified percentage, it's sort of on the CRA website. So don't worry about the specified percentage because in real life, if you were working as a financial planner and you had a client that had a RRIF as one of their accounts, you would have those specified percentages handy, but they are available on the CRA website. So I just want to sort of have a look at what happens then if, let's say, you have a RRIF, how much would need to be taken out if, let's say, you were under 72 at the beginning of the year. So let's have a look at this exercise together. So we have this taxpayer, Larry. In 2024, he transfers all of his money to a RRIF. And in 2024, he is 65. So you can do it at any time. You don't have to wait till the year you turn 71. But then once again, the year after, he must start taking minimum money out of the RRIF. At the beginning of 2024, this is the value of the RRIF. At the beginning of 2025, this is the value of the RRIF. And so the question asks us, what is the minimum amount he must take out of the RRIF in 2024 and 25? Oh, so let's just go back here. So 2024 is the year that the transfer from the RRSP to the RRIF. So in this year, there's no minimum withdrawal required. Now, he can take money out if he wants, but he doesn't have to. And this is the year that he was 65 years old. Then we move to 2025, and this is where he is 66 years old. And so the minimum withdrawal amount will be based on the formula where we take the fair market value of the RIF assets at the beginning of the year, which was 660. And then we divide it by 90 minus his age at the beginning of the year, which was 66. So what's that? That's going to be 24, right? 660 divided by 24. So his minimum withdrawal is going to be 27,500. And this will be again added to 3A as pension income. Now, usually what happens is the bank or the company that is managing the RIF will sort of pay this amount evenly over 12 months. So they'll probably take the 27,500 divided by 12, and it would be 2,292 per month. And there's no withholding tax on the minimum amount withdrawn. Anything above the minimum will have withholding tax. So once again, if you take out just the 27,500, the bank or the investment company will probably divide that by 12 and then put that into your bank account evenly over 12 months, 2,292. And if that's all you're taking out, no withholding tax. But if you take out more than the minimum, then the amount over the minimum, there will be withholding tax. I want to just talk a little bit about sort of this concept of RRSPs and it sort of converting into a RIF. This is sort of not in your textbook. Actually, just let me just stop and see if there's any questions. So question, could you request a lump sum? Yeah, so you can request a lump sum. So just to sort of answer Justin's question, if this is sort of the minimum amount, you could ask for it all at once. So you could ask for it all at once. And once again, there should not be any withholding tax, but you would have to, of course, talk to your bank or financial institution. But for what I've sort of seen in the past, usually they sort of pay it monthly unless you ask them otherwise. If you sort of ask for a lump sum, I don't know if there might be any service charges. I don't know about that part of thing. But yeah, that you can ask for the minimum to be paid sort of all at once rather than spread out evenly over 12 months. Any other questions about this exercise? So I want to just talk a little bit about taking money out of an RRSP. And this is not in the textbook, but for those of you that are maybe pursuing a financial planning career path rather than a CPA, you might have heard this term RRSP meltdown. I don't know if anyone's heard that term, but all they're sort of saying is that when money is taken out of the RRSP, it becomes taxable. And let's say in the year the taxpayer dies, all the RRSP balance is included in the taxpayer's net income for tax purposes, unless it's transferred to a spouse. So if it's transferred to a spouse or some infirm children or grandchildren, it can be done tax-free. So what do you mean by this concept of RSP meltdown? So when money comes out of an RSP, it all becomes taxable. In the year a taxpayer dies, all of the RSP is added to the taxpayer's net income. Unless they're married or they have a spouse or common law partner, then it can be transferred tax-free to their spouse or common law partner or any financially dependent or infirm children or grandchildren. Then that can be done on a tax-free basis. But if the taxpayer has no spouse, or maybe they're widowed, or sort of infirm, financially dependent children, or grandchildren, the tax bill could be huge if the RRSP value is large. So let's say the RSP value is $1 million, which is not unusual for a lot of wealthier individuals once they get to retirement age. If the taxpayer doesn't have a spouse or any infirm financially dependent children or grandchildren, the taxpayer dies, that $1 million is added to their net income. And so that's a huge tax bill on their estate. And so, yes, even though they passed away, they don't have to see the tax bill. But if they wanted to sort of leave a legacy, maybe to some family members or some charity, for example, a huge amount of that $1 million RRSP will be eaten up in taxes. And so that's sort of this concept of RRSP meltdown. Has anybody heard of that term? Those of you in financial planning, has anybody heard of that term? If you have, just sort of make a note of that in the chat. I'm just kind of curious if that was taught to you in any of your financial planning courses. But that's sort of an important concept where if you are a financial planner and you're sort of helping your clients manage their RRSPs, then they need to sort of be aware that when they get close to retirement age, or if they have sort of no spouse or no financially dependent infant children where it can be transferred tax-free, then they have to start melting down their RRSP and bringing some in sort of every year, especially in years that they have no or little income. And so that way their estate is not faced with this huge tax bill when the taxpayer dies. So I just wanted to talk about that concept because that's sort of an important concept to sort of know if you sort of go into the financial planning sort of career path. Questions about chapter 10? I'm going to move over and bring up the chapter 11 Appendix B handout. Now, I was going to wait till next week to do this short handout, but it sort of ties to RSPs in some ways. And then this will just sort of save up a little bit more time for next week because next week is our last class. And I want to make sure that we do get through all of chapter 11 in a timely manner. So this chapter 11 Appendix B handout basically just looks at returns for deceased individuals, kind of like what we were just talking about. When a taxpayer dies, obviously their executor will file their final tax return, but that final tax return will be from January 1st to the date of death. For a deceased tax return, that will be due generally the later of the regular due date or 6 months from the date of death. So let me just sort of give you an example. So the final tax return for a deceased is due the later of 6 months from date of death or the regular filing due date. So let's say we have this taxpayer and let's say their date of death is, let's say, November 15th, 2024. And let's say they were self-employed. So then the final tax return for January 1st to November 15th, 2024 is due the later of 6 months from the date of death. So that would be basically 6 months plus November 15th, 2024. And so what would that be? That would be May, right? Would that be May? Yeah, that would be May. December, January, February, March, April, May. Oh, sorry, date of death is 2024. Yeah, sorry. Data death is 2024. Let me just change that here. So that would be May 15th, 2025. And then the regular filing due date now normally it would be April 15th, but because this individual was self-employed, it would push it to June 15th, 2025, because they're self-employed. And so the later would be June 15th. So that's all that that rule says. If they were not self-employed, then the second number a day would be April 30th, and then the May 15th would be the later of the two. So just sort of keep that in mind that if you end up working and filing tax returns for a deceased individual, the due date is the later of 6 months from the date of death or the regular filing due date. Now, there's sort of some special rules on the date of death return. I kind of just summarize them here. This would just sort of be light coverage on the final exam. Don't expect like any big questions on the date of death return, but just sort of some special rules that sort of good to know if you ever come across a deceased individual's tax return. Generally, charitable donations, those tax credits that you get for charitable donations, are usually limited to 75% of your net income. But in the year of death, up to 100% of net income amount can be claimed for charitable donations. And any amount that cannot be used can be carried back to the preceding year using like on that 100% of net income limit. Medical expenses. Normally you can claim medical expenses for any 12-month period. Remember those medical expense tax credits that we talked about in chapter 4? Usually it can be for any 12-month period ending in the year, but in the year of death, that can be extended for a 24-month period. So once again, just sort of giving you sort of more leeway to use up all those medical expenses that may have accumulated over the last couple of years. If the taxpayer owns any capital property, so any sort of rental property, any stocks, there's a deemed disposition at fair market value. And so once again, if the deceased individual has a lot of assets, a lot of rental properties, that will have a huge impact on their tax bill, especially if it's gone up a lot in value. However, capital property can be transferred to a spouse tax-free. Now, we saw this last week in chapter 9. Remember, we had that tax-free spousal rollover. And so we sort of saw that in chapter 9. And so this can also sort of be done as well at the date of death, where property can be transferred once again to the spouse tax-free. So that could be sort of a bit of a benefit if the deceased has a lot of assets that have gone up in value. It can be transferred tax-free to the surviving spouse. What about your TFSA, your tax-free savings account? It can be transferred to your spouse without any income tax consequences. And the surviving spouse can maintain that as a separate account. So it's not going to impact the surviving spouse own contributions. Remember, there's a certain amount that can be contributed each year. If one spouse passes away and the surviving spouse now owns the deceased spouse tax-free savings account, that will not impact their own contributions that they get to make every year as well. Tax-free savings accounts can also be transferred tax-free to a beneficiary other than the spouse. So let's say the deceased does not have a spouse, or maybe they're widow, and they want to transfer the tax-free savings account amount to their niece or nephew. The niece or nephew is a beneficiary. That can also be done tax-free. There are some sort of rules, though, that any amounts that are eventually withdrawn in excess of the fair market value at the time of death will be included in the beneficiary's income. So if it goes to the spouse, the surviving spouse, they can take the money out without any tax consequences. But if it goes to a beneficiary other than the spouse, the receipt of the tax-free savings account is fine. There's going to be no tax. Let's say the value of the tax-free savings account is $100,000. The beneficiary can withdraw $100,000 without any tax consequences. But if the tax-free savings account grows after the date of death to, let's say, 120,000, and they take out 120,000, then the 20,000 will be taxed to the beneficiary. So that's sort of something to sort of be aware of. We talked about RRSPs. RRSPs can be transferred tax-free to a spouse, common law partner at death, or if they have any financially dependent infirm children or grandchildren, it can also be done tax-free as well. If the RRSP or the RIF goes to others, then the deceased will have to include all of that in their net income. So once again, like I said, when somebody passes away, the value of their RRSP will go into their income unless it goes to a spouse or common law partner or a financially dependent infirm child or grandchild. What about net capital losses? So net capital losses can only be used against taxable capital gains. In the year of death and in the preceding year, it can be applied to any type of income. So generally speaking, net capital losses can only be deducted against taxable capital gains. But in the year of death, if there are any net capital losses still sitting there, they can be applied to any income in the year of death or the immediately preceding year. However, there's one sort of caveat though. If the taxpayer had used up any of this lifetime capital gains deduction, then that could limit the amount of the net capital losses that can be used against any other type of income. The lifetime capital gains deduction is something we'll see in Chapter 11. I'm going to do an example here at the end of this page. I'm going to do an example sort of this here, this concept in a couple minutes. So we'll get back to this concept of using up your net capital losses in the year of death. So I'll come back to that in a second. Obviously, when somebody passes away, they obviously cannot file their own tax return. So usually the legal representative, maybe the executor of the estate, they're going to have to file all the tax returns and pay all the taxes. And then the legal representative will have to get a clearance certificate from the CRA, just making sure that all the taxes have been paid, the CRA is happy. This clearance certificate will now give the executor or the legal representative the ability to distribute all the estate property. So if you are, let's say, assigned as the executor or legal representative of the estate, it does bear quite a bit of responsibility. You're responsible for filing all the tax returns, paying all the taxes. You need to make sure that you get this clearance certificate from the CRA before you start distributing the estate assets to the beneficiaries. Otherwise, you could be liable for those amounts if the taxes are still owing to the CRA. There's also this sort of elective return that can be filed in the year of death as well. So normally you have to, the deceased individual would have to make sure that their regular tax return is filed, but there's sort of this additional return called the rights and things return. Certain amounts can go on this additional return. This is basically just another T1 return. It's just called the rights or thing return. And basically on this rights and things return, you can include things such as unpaid salaries, unpaid vacation pay, any sort of dividends that were declared but not yet paid. And the benefit of doing this is that if you separate this income into a separate T1 return, you get sort of the lower federal tax rates. So rather than include all the return on one T1, if you separate these income amounts into this elective rights and things return, then you get access to the lower 15% federal tax rate. And then it also allows you to also claim certain tax credits twice, one on the regular return and one on those rights and things return. So the basic personal amount is a tax credit that you can claim on both. So once again, not something that you need to be worried about being tested on greatly on the final exam, but just sort of a basic understanding of these concepts. The one thing I want to do in a little bit more detail, though, is this sort of concept of using up your net capital losses in the year of death. And we're just going to look at this example here. So generally, net capital losses can only be used against taxable capital gains. So Tanya dies in August of 2024. Let's just actually put a date here. Let's say August 15th. I'm just going to add a date here. And at the time of death, she has a net capital loss of 21,800. And remember we talked about those deemed disposition rules? So she has this art collection, and she had to, there's a, even though it's still under her estate, there's a deemed disposition at fair market value, and that's going to result in a taxable capital gain of 15,500. She's never used this capital gains deduction. Remember we talked about this lifetime capital gains deduction up here that we're going to see in chapter 11? That could sort of taint some of the net capital loss you can sort of use against other income, but she didn't use any of that, so that's fine. And prior to death, her employment income was 47,000. Now we're not going to worry about the rights and things return. So we're just going to think about, okay, first of all, when does her executor have to file the 2024 T1 return? So the 2024 T1 return will be from January 1st to August 15th, 2024. It's going to be due the later of 6 months from the date of death. So 6 months from August 15th, that's going to be February, right? February 15th, 2025. And the regular filing due date, she's an employee, no self-employment. So April 30th, 2025. So the later will be April 30th, 2025. So that's when her legal representative or executor has to file the date of death return. So then let's talk about how we can use these net capital losses. So the first thing we need to do is figure out what is her net income for tax purposes. So 3A, we have her employment income of 47,000 plus 3B, which is the taxable capital gain of 15,005. And so the net income for tax purposes will be 62,500. 62. And so remember we said we have this net capital loss of 21,800. So normally the net capital loss can only be used against taxable capital gain. But the way that this works is that, yes, first, so remember to use up these net capital losses, we first have to calculate net income. And then when we calculate taxable income, that's when we use these loss carryovers. So first, we will apply the net capital loss against the taxable capital gain. So first of all, we'll just sort of apply it the regular way. And the amount of the net taxable capital gain was 15,500. So then we do a quick subtotal. And so that's still going to leave 47,000. And so we've used up 15,500. And so that leaves 6,300. And so the remaining 6,300, we can now apply it sort of with a second step against any income. And so we still have 6,300. And so the taxable income will be 40,700. So this is if she never used up any of this lifetime capital gains deduction. So if you just basically, we can use that net capital loss against any type of income. That's pretty straightforward. But let's just sort of change the facts a bit. Let's say now we'll add this new fact. And then Tanya has used up, let's say 5,000 of the lifetime capital gains deduction. Now, this lifetime capital gains deduction we'll explore it in chapter 11, but it kind of works the same way. It's based on your capital gains. So if, let's say, she had 10,000 in capital gains, 50% of that would be 5,000. So she used up 5,000 of this deduction to basically not have to pay tax on this taxable capital gain of 5,000. So that's basically what the lifetime capital gains deduction is. It's when you sort of sell certain types of property, like shares in a small business, then you can use this deduction, this lifetime capital gains deduction, to offset the taxable capital gains on the sale of shares in sort of certain small businesses. And once again, we'll talk about that more in next week. But the fact that she used up 5,000 of the lifetime capital gains deduction, that will now taint some of what she can claim in this second step here. So let me just sort of show you how that would be done. I'm just going to move this to a new page so we can see it all. So this first part will be the same. I'm just going to copy and paste this here. So this first part will be the same. So we're still going to calculate the net income, and we will still apply the net capital loss against the taxable capital gain. That is fine. But then what will happen is, with this remaining 6,300, with the 6,300 remaining, so let me just sort of put that over here. It must be reduced by the 5,000, which was that lifetime capital gains deduction that was used up, leaving only 1,300, which may be used against any other type of income. So what they're saying is that if you've used up some of this lifetime capital gains deduction to basically not pay tax on the sale of certain shares where you got this, where you have this capital gain, so you basically got a tax break by using up this 5,000 lifetime capital gains deduction, then that's going to limit the amount that you can use of this net capital loss that you can use to apply against any other income. You can't sort of have the best of both worlds. You've used up some of this deduction to not pay tax on these capital gains previously. So now that's going to reduce the amount of the 6,300 that you can use to apply against any other income in the date of death. So then only 1,300 is left. And so in this example, the taxable income will now be 45,700. So once again, just sort of focus what's on this handout here for final exam purposes. This is probably the only thing that we've sort of done in detail. The rest are just sort of some basic concepts that you have to understand about the date of death return. Any questions?